All right, welcome to our panel on low interest rates and financial markets. We have three great panelists, and so I'm going to not waste a lot of time with introductory remarks, but I will say one thing, which is to submit a question for consideration, we're going to use the conference app. So if you go to the app and open the page for this session, you'll see that there's a little bubble that looks like a shorthand for a conversation that would be coming out of a cartoon character's mouth. If you tap on that, you can enter a question that'll be for consideration once we get to that. So the order of events are that we're going to start with Governor Jay Powell, then we'll have Rajan speak, and then Ken Griffin will speak third. We'll then do a little bit of back and forth amongst ourselves, and then we'll open it up for questions. So Governor Powell, the floor is yours.
Thanks very much, Anil. Is this on? Yes. Thanks. It's great to be here. I appreciate the invitation. And this is a great topic, low interest rates in the financial system. And the framing of the topic kind of raises the question of whether low interest rates have somehow undermined the stability and functioning of the financial system. So I'm going to argue that low for long interest rates have supported slow but steady progress to full employment and stable prices, which has in turn supported financial stability. Indeed, by many measures, the U.S. financial system is now much stronger than it was before the crisis. That said, I'll also talk about the difficult trade-offs that there are to manage. Over time, low rates can put pressure on the business models of financial institutions, and low rates can lead to excessive leverage and broadly unsustainable asset prices, things that we watch carefully for but do not observe today. So I'll start by focusing briefly on the macroeconomic effects of low interest rates, and I'll then turn to the condition of the financial system, in particular, its interplay with low rates. And as always, the views I express here today are mine alone and not necessarily those of anyone else at the Fed. So, the financial crisis and the Great Recession posed the most significant macroeconomic challenges for the United States in a half century, leaving behind high unemployment and below target inflation and calling for highly accommodative monetary policies. Isolating the effects of these policies is challenging, but studies generally show that they lowered rates across the curve and moved other asset prices as well. It's even more challenging to evaluate their effects on aggregate demand. Low rates and higher asset prices should support household and business spending and investment through various channels. But low rates may also perversely induce some households to save more in order to meet their targets for retirement. And low rates have clearly not produced a boom in corporate investment, although standard accelerator models suggest that investment has largely been consistent with the weak pace of growth. Nonetheless, there is good reason to think that low rates have provided significant support for demand, and that is my view. As you can see in slide 1, we are now close to meeting our dual mandate, which I would argue is a reasonable summary statistic for the effects of policy. While growth has been frustratingly slow, employment gains have been solid. Overall, this is a good outcome considering the scope of the crisis and the relatively poorer performance of other major advanced economies. It's also worth pointing out, while monetary policy is certainly part of the story, there are also many other factors that are holding down long-term interest rates. The next slide shows that long-term nominal and real rates have been declining for over 30 years. And this slide decomposes long-term nominal yields into expected short-term real rates, expected future inflation, and a term premium, based on one of the board's workhorse term structure models. All three components have contributed to the downward trend in long-term nominal yields. And that downward trend in nominal premiums likely reflects both lower inflation risk and the fact that with inflation expectations anchored, nominal bonds have become an increasingly good hedge against market risk. That's made bonds a more attractive investment and reduced the term premium. As shown in the next slide, a regression of the 10-year term premium on measures of 10-year inflation expectations and a rolling beta of Treasury returns with respect to equity returns, which proxies for the hedging value of bonds, shows that these two factors can account for a large part of the decline in the term premium. There are other factors depressing rates as well, including regulations that require financial institutions to hold more safe, high-quality liquid assets, global factors which, due to anxiety about the foreign outlook, increase demand for U.S. assets, And it's also worth remembering that real rates around the globe are quite low, reflecting the step down of productivity growth over the past 10 years, as well as changes in savings and investment due to demographic change. The last thing I want to touch on briefly before I get to the substance of this is just to point out that both improved risk management at the largest, most systemically important financial institutions, what we call the SIFIs, and stronger regulation have made the core of the system much stronger and more resilient than before the crisis. The SIFIs now have more stable funding, hold much more capital and liquidity, are more conscious of their risks, and are far more resolvable should they fail. Many aspects of our financial market infrastructure, including tri-party repo market, central counterparties, and the money markets, to name a few, are more robust as well. So far, I've argued that low rates have supported aggregate demand and brought us very close to full employment and 2% inflation. That forces, in addition to monetary policy, have been pushing rates lower for more than 30 years, and that the core of the financial system is now much stronger and more resilient than before the crisis. All of that said, I would also agree that monetary policy may sometimes face trade-offs between macroeconomic objectives and financial stability. Indeed, it would be a divine coincidence if that were not the case. There are times when all of these objectives are aligned. For example, the Fed's initial unconventional policies, QE1, supported both market functioning and aggregate demand. More broadly, though, post-crisis monetary policy supported asset values, reduced interest payments, and increased both employment and income. And all of those effects are likely to have limited defaults and foreclosures and bolstered the balance sheets of households, businesses, and financial intermediaries, leaving the system more robust. At times, though, there will be trade-offs. Low for long interest rates can have adverse effects on financial institutions and markets through a number of plausible channels, as listed on the next slide. After all, low interest rates are intended to encourage some risk-taking. The question is whether they have encouraged excessive risk-taking through the buildup of leverage or unsustainably high asset prices or the misallocation of capital. And that question is particularly important in this era. Historically, of course, recessions have occurred when the Fed has tightened to control inflation. More recently, the last couple of cycles, with inflation under control, overheating has shown up in the form of financial excess. Core PCE remained close to or below 2% during both the late 90s stock market bubble and the mid-2000s housing bubble that led to the financial crisis. In fact, annual core PCE has not touched 3%, since 1994. Real short and long-term rates were relatively high in the late 90s, so financial excess can arise without a low-rate environment. Nonetheless, the current extended period of very low nominal rates does call for a high degree of vigilance against the buildup of risks to the stability of the financial system. So if we look at the channels listed here, the picture, in my view, is a mixed one. But the bottom line is that there has not been an excessive buildup of leverage, maturity transformation, or broadly unsustainable asset prices. And I'll go into that in some more detail. Go to the next slide. Long-term interest rates have weighed on profitability in the financial sector, although firms have so far been able to cope with those pressures. As shown on this slide, net interest margins for most banks have held up surprisingly well, although they have moved down for the largest banks. Return on assets, shown on the right, for both groups have recovered but remain below pre-crisis levels. The next slide shows that life insurers have substantially underperformed the broader equity market since 2007, suggesting that investors see this low-rate environment as a drag on profitability. Even so, data on the asset portfolios of life insurers do not show increased risk-taking. And the same is true for banks as well. Both the regulatory environment and banks' own attitudes towards risk following the financial crisis have helped ensure that the largest banks have not taken on excessive credit or duration risk relative to their capital cushions. Low rates have provided support for asset valuations. Indeed, that is part of their design. But I do not see valuations as significantly out of line with historical experience. The next slide shows, as you know, equity prices have increased considerably recently, pushing the forward price-earnings ratio further above its historical median. And equity premiums, shown on the right, which is the expected return above the risk-free rate for taking equity risk, have declined, but not to the point at which they are out of line with historical experience. Turning to the non-financial corporate sector, valuation pressures there are most concerning when leverage is high and where real estate is involved. So start with residential real estate, where valuations have been in line with rents and household incomes in recent years, and the ratio of mortgage debt to income is well below its pre-crisis peak and still declining. The commercial real estate sector is a contrast. Valuations are quite high in some markets. And in the non-financial corporate sector, gross leverage is high by historical standards. Low long-term rates have encouraged corporate debt issuance at the same time that some regulations, particularly the Volcker Rule, have discouraged banks from holding and making markets in such debt. The next slide shows that high-risk corporate debt, which is the sum of high-yield bonds and leveraged loans, grew rapidly in 2013 and 2014, although growth has declined sharply since then, as you can see. And first, firms are also holding high levels of liquidity, so net leverage is not elevated. Firms have also termed out their debt. They've lengthened their maturity profiles, and of course, at these rates, interest coverage ratios are high. Finally, as the next slide shows, Greenwood and Hanson's measure of the share of high yield in overall issuance is at a relatively low level. And also worth pointing out that this debt is now held more by unlevered investors, CDOs, CLOs, rather than the banks. So overall, I don't see the leveraged finance markets as posing undue financial stability risks, and if risk-taking does not threaten financial stability, it's not the Fed's job to stop people from losing money or making money. As I said, I see a mixed picture. Low interest rates have encouraged risk-taking and higher leverage in some sectors and have weighed on profitability in others, but the areas where there are signs of excess are isolated. So to sum up, low interest rates have supported economic activity and gradually brought us back to full employment and 2% inflation. Better regulation and risk management have so far minimized the trade-offs between our macroeconomic objectives on the one hand and financial stability on the other. Still, that said, a period of low rates for a long time could present significant challenges for monetary policy. It could also put pressure on the business models of some financial institutions. Ultimately, though, the only way to get sustainably higher interest rates is to improve the broader environment for growth by adopting policies designed to increase productivity and potential output over the long term, policies that are mainly outside the scope of our work at the Federal Reserve. Thanks. I'll look forward to our discussion.
Thank you.
Thank you very much for having me in this session. And it's always hard to follow such a comprehensive presentation as Governor Powell's. And I have to say I agree with everything in it. I just put a little bit of a different emphasis, but I think we're broadly on the same page. Let me, at the risk of repeating or going over some of the territory, just to set the grounds for the discussion that follows, and I'll take just a few minutes. So what's the case for low for long and for continuing this process? I guess many central bankers would say that the neutral real rate is low, and essentially they're trying to mirror that with policy. Why is that real rate low? I guess it's anybody's guess. It's sort of another way of entering the secular stagnation debate. Investment is low. Why is investment low? Because the profitability of investment might be perceived to be low, or the uncertainty surrounding investment, the political uncertainty, other kinds of uncertainty may be relatively high. For whatever reason, we're not seeing a huge effect on corporate investment of relatively low rates, which suggests that perhaps in order to incentivize it, rates should even go even lower or remain low for a sustained period of time. Of course, the second necessary assumption for it to be an important aspect of policy is the transmission channels should still be working in order to enhance aspects of demand that might incentivize investment, as well as keeping the cost of capital low so investment takes off. So the argument really is by keeping rates low, the interest rate sensitive sectors will get a boost. And we've seen some effects of that, for example, in mortgages and housing, but certainly not in corporate investment. And also household borrowing has been steadily tapering down, which is probably a good thing because it had gone up too high, and now is flattening out household leverage. So broadly, I think the interest-sensitive channels are very limited at this point, and certainly don't seem to be a strong boost to economic growth, which leads to the question, how much more do we have to keep it low, and how much lower do we have to go to get them coming back up, and whether, in fact, keeping low for long is as good a policy when there are over-leveraged sectors in the economy. Second way this might work is through wealth effects, and we've seen some papers now circulating in the job market about recapitalization effects, that one of the ways that this seems to work is that banks hold long-term fixed income securities, and by keeping rates low, you boost the value of bank assets, and that feeds into bank capital, and that has a effect on bank credit. I think the recapitalization effects might be there, but one should be asking the question, is this the best way we want to recapitalize banks, or are there more direct ways rather than perhaps inflating the entire bond market? As to wealth effects, it seems to me that it depends a lot on whether the wealth effects are seen as permanent or temporary. If, in fact, the boost to wealth by keeping rates low is seen as something that will eventually come off when interest rates normalize, somebody who's investing for the longer term, is that something that they're going to see as a permanent increase in wealth and therefore consume out of it or not? I think that's an open question. The second big reason is, of course, an important one, that it facilitates, low interest rates facilitates deleveraging and facilitates the management of existing levels of debt, permits refinancing for certain entities that are over-leveraged and reducing their cost of debt. And certainly this has been a positive over time and has helped the management of debt loads in a number of countries which have where deleveraging is going on. But I think perhaps the most important rationale you hear around the world for why low for long is a good thing is that central banks see the need to be seen to act because they're in danger of violating the inflation mandate on the lower side. They can't simply throw up their hand and say the instruments we have aren't quite working at this point. They have to try everything they can to avoid being seen as giving up on the inflation mandate. And that's why we go from more exotic instruments to yet more exotic instruments in an attempt to try and show that even if you're not quite there, you ain't done yet. There's still a number of weapons you have up your sleeve, and it's an attempt to preserve credibility. So those are some of the reasons why, in fact, low for long, I think, has been in operation. I think some are, in fact, valid reasons where we see some positive effects. But I would argue that over time, the positive effects are becoming weaker and weaker, and as Governor Powell said, much of the action has to be on the side that the central bank doesn't control, attempts to enhance potential growth in the economy, to enhance productivity, to reduce the uncertainty surrounding investment, rather than on the cost of capital, which is about as low as it can be. So let's turn next to the case against continuing, which to my mind has gotten stronger over time. The first, again, some of these issues have been referred to by Governor Powell. Is it still working in the right direction? In a number of countries, there is concern that as we get aging populations, that see retirement on the horizon, that haven't still built up their nest egg, and typically invest in fixed income securities where it's more about the interest rate rather than on capital gains. Those kinds of households would be trading off income versus substitution effects. Yes, low interest rates would give them incentives to go out and spend because the returns to savings are relatively small. But if they really worry about building up enough of a nest egg, they may in fact say, well, maybe I need to save more in order to meet my end-of-life goals, and that would create a pressure to save. Certainly, the language in Germany and in Japan seems to reflect these kinds of concerns, may be different in the United States. A second rationale is it depends on how you see asset prices. If you see asset prices as being unnaturally low, especially in fixed income markets, but also relatedly in equity markets, because of a concerted move by central banks around the world, then there is obviously a fear of asset price volatility, especially if you believe a number of investors are motivated by a search for yield. As interest rates normalize, you fear this will come off. And if you're an investor, if you're a saver thinking about the longer term, with prospects of asset price volatility, first, you don't know where to go, and second, you think whatever savings you need in the longer term, given this volatility, is probably not enough, and therefore you need to save more. A third rationale for why low interest rates may be problematic is the lack of exit. And this is, I know this sounds a lot like the liquidationist view. Andrew Mellon, liquidate, liquidate, liquidate. This was the Great Depression, and it's held up as the kind of nonsense that was being talked then. But there is a sense in which the interest rate is a price. It is a price, and prices do convey signals about what is good and what is bad, what is good investment, what is bad investment. If we have too low a price for capital, perhaps you get overinvestment. This argument is not about overinvestment, but over persistence of inefficient producers who are not knocked out of business because they are able to service low-cost capital that they have access to, and in a more normal interest rate environment would clear the way for more efficient producers and therefore increase potential growth. Again, this is a concern more in Europe. There are some studies showing that this might in fact be the case, but it is certainly something that people worry about. So I would argue as we go further in this regime, there certainly is a question about, is it still working in the right direction? Second question is it good for the longer term? Obviously, there are positive effects potentially if the first slide, the elements there were important. But one of the things you have to worry about is liquidity and leverage seem to be twinned concepts. As you enhance liquidity in markets, leverage builds up. And the other factors that would support leverage in less liquid times are ignored. You spend less time creating the infrastructure to support leverage. And so in good times, when liquidity is high, leverage builds up. But as the liquidity is withdrawn, you don't have anything to back that leverage in bad times. So leverage can be a real problem once the liquidity turns. This is something that Doug Diamond and I have been working on. I'm trying to summarize the whole paper in 3 lines, but it's essentially liquidity leads to leverage. And leverage in a very illiquid environment is much worse because the institutions and the supports to leverage have actually weakened during the period of sustained liquidity. So a period of low for long is a period when the market tends to neglect other ways of supporting leverage, and the fall can be relatively large when that support is removed. This is not a fault of the central banks, but it is a consequence of central bank policy that the risks build up. And we've already talked about the potential for holes appearing elsewhere as institutions search for yield. I should emphasize, these holes may not show up now. when asset prices are buoyant. But they may show up when asset prices revert to a more normal level. That's not today. It's in Warren Buffett's inimitable language, when the tide flows out. That's when you see which institutions have been swimming in the buff, and I think we will see some of them at that point. Lastly, of course, the spillover effects from this kind of policy. To my mind, the spillover effects are much larger earlier on. Now, emerging markets have, a lot of emerging markets saw easy capital come in, have built up substantial amounts of leverage in countries which are least able to manage this kind of leverage. Today, that leverage is starting, the kind of capital flows that came in are starting to move out. We have to see whether the countries have prepared enough. My guess is a few have not. And we will see those countries also left high and dry. So to end, let me say that I'm firmly in the camp that normalization is appropriate at this time. Clearly, the normalizer will experience currency appreciation and headwinds to growth. The first out of the box to normalize will experience this. But they will also create rooms for others to normalize in a more sensible way. I think it's better to have virtuous exit in a steady fashion rather than collectively be held in a prisoner's dilemma where nobody wants to exit because the first guy to exit will, in fact, attract currency appreciation. So to my mind, what we're seeing now, a normalization led by the Fed, is probably quite appropriate. I would also argue that we probably will see more asset price volatility because asset prices have been priced for a continuation of easy times, and leverage has also been built up in perception of easy times, and we will see some volatility as things shift. But to my mind, this is the price paid for normalization. This is a price paid for low for long, and we have to pay it now, otherwise we'll have to pay a higher price in the future. So using this as a reason to not doing it, I think is problematic. And finally, I will argue that in these fairly exotic new policies, central banks have, in fact, tried to deliver on their mandate. But to some extent, they've sort of stepped out of the box. The earlier view was there's a politically determined mandate, inflation target of does and such given by political authorities based on what they feel the electorate deserves. And there's operational flexibility for central banks, which means they try and deliver on the mandate using the instruments that they control. By stepping outside the normal realm of instruments, with all these acronyms, QE, QQE, LTRO, et cetera, my sense is the electorate is now starting to worry about whether, in fact, central banks have exceeded what was, in fact, given to them as operational flexibility. They've sort of stepped beyond those bounds, which is why there's a lot of attention being paid by the political establishment. And I think this is one of the consequences, which is why I think normalization is probably appropriate before this gets problematic. Thank you.
Thank you so very much. It is an honor to follow the two gentlemen who preceded me, and I'm going to try to cover a bit of ground that has not yet been covered today. So I'm going to skip through a number of slides as I run through this presentation. First, there were four agenda questions posed to me with respect to today's presentation, and there they are just to quickly take a look at. The first one was lessons learned from aggressive monetary policy. And I'm going to skip the sort of general rhetoric on how the stock market has dramatically appreciated both domestically and abroad. This is well understood as an impact of QE. On the high yield market in particular, we touched on this earlier, there's been a dramatic compression in risk premium post the financial crisis back to levels that mirrored that of pre the financial crisis. And I think it's worthy of note that during the midst of the financial crisis, we talked about how over-levered corporate America was. Well, lo and behold, we are now more levered in corporate America than ever before. Yes, a number of companies are sitting on cash reserves abroad, but there is a significant increase in the use of leverage in corporate America, and we see this globally. Now, it would be wonderful if the story behind this mirrored one of the goals of QE, which was to encourage corporate investment, but unfortunately, we know that hasn't been the case. We've seen a recasting of corporate America's balance sheet, stock repurchases, dividends, M&A activity, offset by a dramatic increase in corporate leverage. This has not fueled the explosive growth in jobs that we're all hoping for. Now, one of the things that has not been talked about today is the incredible impact that QE has had on intergenerational wealth. If we look at the wealth of households 65 to 74, we've seen a dramatic improvement in their household wealth from the darkest days of the crisis. In fact, they've recovered their losses almost fully from the start of the great financial crisis. But the lower part of this page, I think, explains some of the reason that Bernie Sanders was so popular. The 35-year-olds have been left out of this party. They have not seen a recovery in their wealth. In fact, they've seen a material decrease in their wealth as to prior from the financial crisis. Now, one of the obvious reasons for this is that programs intended to increase the value of assets make the rich richer. And by the time you're in your 50s and 60s, you've saved money, and the 20-year-olds have yet had a chance to acquire meaningful assets. So one of the really interesting dynamics that is not really discussed in the context of the programs around the world is this incredible intergenerational impact that we've had across our society and societies in Europe and Japan. Let's talk about a couple of the lessons that we've learned from negative rates. So clearly, negative rates had 4 key channels of impact. They were supposed to encourage commercial banks to lend more, businesses to invest more, households to save less and spend more, and to trigger a decline in the value of the currency of the country engaging in negative rates so as to improve the terms of trade, more exports, less imports. Now, of note, we have not seen this quite play out as anticipated. Japan's stock market took a precipitous fall when the Bank of Japan surprised with a move to negative interest rates. In Europe, we saw 2 significant declines in the back of a movement to negative interest rates. So, to recap, the start of QE around the world, the start of the reduction in rates around the world, led to a great improvement in asset prices. But when central banks went from 0 to negative rates, I think we saw, in some sense, a level of panic. Have the central banks lost control of their monetary policy? If we're going negative, what does that really mean for our economy? Is the government in control? And so negative rates, although well-intended, have not had the impact anticipated. In fact, if we look at savings rates around the world, in particular in countries where we've embraced negative rates, have just marched higher. As it was put earlier, people are often trying to hit lifetime savings goals. You need to increase your rate of savings to do so in a negative rate environment. And of course, many institutions and contractual commitments were designed around a higher real and nominal rate environment. Insurance companies, life insurance companies in particular, were designed or architected around a higher real rate environment. We talked earlier about how the stocks of these companies would dramatically underperform the broader market. Banks have also been architected around a higher real rate environment. And one of the real interesting questions in Europe that European banks faced was, as rates went negative, do you start to charge your customers for leaving money on deposit? We actually know that large European banks priced out the storage costs for large sums of cash money. How much does it cost to store $1 billion of cash? These were not ever anticipated outcomes of the policies that have unfolded. And of course, defined benefit plans, which are very common in the United States, and in particular with respect to state and local finances, have been unequivocally left in a great state of disarray on the back of very low interest rates that prevail today. There's no way they're going to achieve their 7.5% to 8% promised returns in an environment where the 10-year bond yields 2.4%. So are negative rates in Europe and Japan warranted? Well, first of all, I think it's the Americans like to sort of pat themselves in the back that QE and low interest rates were most powerful and most effective in our country. And perhaps there's sort of this sense that we did it first and we were the innovators and we reaped the rewards of that innovation. I think it's a bit of a different story. The U.S. has had dramatically lower real rates post-crisis. Real rates in the United States over the last 5 years have averaged negative 1.2% and are currently negative 1.49%. Our inflation rate is simply higher than that of Japan and Europe, where real rates have been dramatically higher than we have here in the United States. So Japan and Europe were forced in some sense to cross the zero boundary to try to have a monetary policy as aggressive and as effective as ours. And unfortunately, crossing that zero boundary created probably a level of just psychological anxiety that was counterproductive. Now, if you ask me, I love the words earlier that were spoken. Central banks have been trying everything they can to achieve their policy mandates. But have they been empowered to the point of trying to offset poor policy? I don't think the electorates in most countries have viewed their central banks as the de facto counterweight to poor policies from their legislative branches. The issues in Europe should not focus on hyper-aggressive monetary policy. They should focus on structural reform. Here's the OECD Global Competitiveness Report of the leading countries around the world. The Europeans are resoundingly awful at managing their labor markets and managing their regulatory burden. And no amount of central bank effort is going to offset the very rigid labor markets of Southern Europe and the very poor policies that discourage the formation and growth of businesses. A question that I often pose is, show me the Google, Facebook, and Amazon of Europe. Japan, not much better. Abe's famous 3 arrows has only had one actually leave the bow. The monetary policy arrow, the easiest arrow. It's pretty easy to basically say, we're going to cut rates. It doesn't require a lot of painful legislation, a lot of painful dialogue with your electorate. The other 2 key arrows, flexible fiscal policy, the rebuilding of the infrastructure of Japan, only modestly touched. And the most important arrow, the reform of labor markets and opening of the borders to immigration, for all intents and purposes, untouched. So are central banks distorting markets? Of course. I mean, this is the explicit goal of these policies. Ben Bernanke's quote lays it out pretty clearly. And so we are now 8 years post-financial crisis, and we are still in a moment in time where we are seeing incredibly aggressive monetary policy, which I think reflects a shortcoming in our willingness to take on difficult but well-needed labor market and regulatory reforms. Thank you so much for your time today.
All right. So before we turn to the floor, let's take up a couple of things that were mentioned. Let me start by putting together something that Ken and Raghu touched on, which is Raghu mentioned the appreciation of the currency that follows from normalizing. And one thing that you're bound to hear more of if the Fed keeps tightening is that partly what happens when they tighten is financial conditions tighten. And at some point, you can get into the situation where people will say, well, the financial conditions are already tightened, the Fed doesn't have to do more. I'd like to get your reaction to that view that the market's already taking care of it, so the Fed can go slow. They really don't need to do very much. So do you put any weight in that argument?
Well, you want me to take a first crack? I mean, the two are related. The conditions are tightening because of an anticipation of continued Fed tightening. So if the Fed backs off, it has to take into account what effect it will have on the tightening conditions. They may also back off at the same time. So it's a very difficult policy road. How much
taking into account the effects of the exchange rate and so on. I do think it is important to emphasize that on the way down, you get a tailwind from the lower exchange rate, and the headwind is going to be there when you come out. It does have the positive spillover effect on creating room for other central banks. But of course, the Fed has to take into account the effect on activity, taking into account the appreciation.
Anything?
Sure. So, I mean, our job is stable prices and full employment. It's not raise interest rates or lower interest rates. And I think to echo what Professor Rajan said, you know, just to take an example, we have to take broader financial conditions into effect. In fact, that's what matters. The policy rate only matters insofar as it affects broader financial conditions. You had a situation since the middle of 2014 to the end of 2015 where the dollar went up 20%. So that has to be taken into account, and it largely in expectation of I suppose, of monetary policy tightening. But again, it really is broader financial conditions that matter, not so much the level of the policy rate, and it's a hard thing to play off, but you really have to consider the broader conditions.
Well, I mean, one of the things to keep in mind with respect to the dollar appreciation over the last couple of years has been the disintegration of the European Union. Brexit is an incredible event in the history of the EU, and there, of course, continues to be great uncertainty about how Southern Europe and Northern Europe are going to be able to sustain the current union. And so one of the things that's helped the dollar has not just been differences in interest rates, it's been a sense that once again the dollar is the true reserve currency of the world. Whereas if you went back to 2005, 2004, I think there was a sense that the best days of the dollar as the reserve currency were behind us. You saw central bank reserves in euros increasing, the talk of the increasing role of the RMB in central bank policy. Those days are past us again. The dollar is again the de facto safe harbor currency for the world, and appreciation of the dollar reflects both interest rate policy, but I think more importantly, the preservation of wealth that people from around the world feel in owning dollar-denominated assets.
Let me ask you a question about another question about normalization. It seems that one of the things that's gone on in the markets is that everybody is waiting for the next Fed press conference and for Janet Yellen to step up and say what they're going to do. It didn't used to be the case that you had to wait for the Fed to give you a signal to know, when risk on, risk off, and all kinds of other things happen. So how do we get back to a situation where the Fed speak is not the single most important thing moving lots of asset prices? What can they do? And are you going to have to live through some version of the taper tantrum to get the markets unaddicted?
So I'll let you off the hook on this one. We used to talk about which hand Greenspan carried his briefcase in. So if you think the financial markets aren't fixated on the Fed in the past, it's a revisionist history. There used to literally be discussion that his briefcase was in his right hand versus his left hand, had different implications for interest rate policy. All right, now he was inscrutable often in what he said, but nonetheless, the financial markets around the world have always been focused on the acts of central banks.
Sure.
There's no doubt that today there's a heightened interest because the policies themselves have become more, in some sense, bolder, more experimental, more uncertainty associated with these policies. But central bank policy in financial markets has been incredibly important my entire career in finance.
But you don't want to take the bait on whether they're going to have to live through some withdrawal pains and.
I mean, of course we are. If we're going to raise rates in the United States by a meaningful amount, we're going to depreciate the value of our bond market, and there's going to be losses imposed in the back of that. That's just reality, and that's in some sense I'd like to think that's a good outcome as our economy continues to strengthen. Nothing like real wage growth to drive higher rates would be great for America.
Okay. Can I have a couple thoughts on that? Yeah. So I would say there are two separate things on this. The first is that I completely agree with Ken that this has been. I just finishing the new Greenspan biography, which talks a lot about the left hand and the right hand in the briefcase and that sort of thing. So it's always been the case. But what's been different in the current environment has been the policy mix being so skewed to monetary policy and away from other levers of policy. So, and I think it would be healthy, and we may actually be getting ready to see some of this. We've been in a world with tight fiscal policy, tight regulatory policy, and monetary policy trying to do everything. We may be moving more to a more balanced policy mix where we have what sounds like more business-friendly regulation and possibly more fiscal support, and monetary policy able to hand it off. And I think that's a healthier thing, and that would get us a step or two away from the focus on all of our communications. The second thing to say is that there was this revolution that lasted 20 years or more, starting in the mid-'90s on central bank communications, and reaching its culmination under former Chairman Bernanke's terms. And we went from not even, when I was in the Treasury Department 25 years ago, the Fed didn't make any announcement at all after it moved. I had to call up Don Cohn to find out what they had done. That's literally how you found out. So now we go through this long process where now we came to believe that communication about the forward path is important and helps markets and lets the markets do their work for us. You wind up in a world where we have what's called the dot plot, which was really an interim, sort of intermediate equilibrium on the way to a consensus forecast. And the beauty of a consensus forecast is if you could broadly get everyone to agree to that, you could then show the tremendous uncertainty around that forecast by showing alternative simulations so that people wouldn't fixate on a particular path, because let's face it, any forecast is highly uncertain, particularly at the present time. So just to come to the point, with the dot plot, I think all of this communication technology, particularly the dot plot that we put out there, encouraged, there's just too much attention on the median dot and who wants 3 rate increases this year and who wants 2 and who wants 4. It's just, the truth is no one knows. It's highly uncertain. And so I would say we can probably address that by talking less about the dot plot and talking less about, and more about uncertainty, frankly, more about the tremendous uncertainty that surrounds all of our forecasts.
You think the dot plot's outlived its usefulness?
I wouldn't say that. I would say that it does provide certain benefits. You can derive and people have started doing this, derive all sorts of interesting insights about the committee's objective function if you're willing to do a little bit of work doing that with an IS curve and using the median and that sort of thing. But I think it would be very healthy if we could change the focus away from the median dots, because let's face it, it's not going to be a good predictor of what actually happens unless we hit the median forecast, which almost never happens. It's either going to be better or worse. And really the most important thing for the market to understand is how the members of the committee will react to better or worse. That's really what's important, not two rate increases, 3 rate increases.
Want to add anything on that? Okay, I'm starting to get finally some questions from the audience, so let me take one of those. There was comments, at least Ken, on structural reforms in Europe. Do you have a wish list for what you'd like to see there? And let me add one other thing. I guess there was implicit discussion about the condition of the banks and how low rates have afflicted the banks. But the price-to-book ratios in global banks are much lower than they were, and especially in Europe, prior to the crisis. I mean, is that a first-order problem, or is that more of a symptom of other things? So, I mean, do we need to put any special attention on the banks, or is that just they'll take care of themselves if you deal with the other structural reforms? So, anything you guys want to say on that dimension?
Well, so touching on the European banks versus the U.S. banks, I think it's very important to take a step back to 100,000 feet. Roughly 4 out of 5 dollars of credit in corporate America exist in our capital markets. So the banking system for corporate credit provision to the vast majority of corporate America, not that important. Credit risk in the United States is underwritten by mutual funds, by pension plans, by hedge funds, by a broad array of market participants. Europe's the inverse. 4 out of $5 borrowed by corporate Europe comes from their banking system, and the European banks are responsible for underwriting and bearing the credit risk of their activity. Now, the price-to-book ratios in Europe reflect the significant anticipated losses in their credit portfolios. The European banks have not been aggressive at dealing with poorly performing or non-performing loans, and this is reflected in the very low price-to-book ratios of the stocks, particularly in Europe. So what would be very helpful for the Europeans to do would be, one, they should be pushing more of their credit markets into the capital markets, where risk can be better priced, better distributed, better borne by society. Number two, they should force the European banks to start to address their non-performing loans, allowing zombie companies to continue to exist. We've seen this play out in Japan, keeps resources trapped in businesses, people, know-how, in businesses that aren't capable. And if you want to have a vibrant economy, you need to let failure take place. It's just that simple.
So you think if the alternative was, well, the NIM, the net interest margins have just been destroyed and are going to be low forever, it's not really a problem with the stuff that's on the books now. You firmly reject that view. You think it's the assets in place are bad, and it's not that the future profitability is kind of seriously impaired.
Well, the
Maybe
second's
both.
certainly true,
Yeah.
and there's if we want to make this more complicated, okay? So you've got the issue of the already in place assets, which are in many parts of Europe struggling. Globally, we've demanded a lot more cap on our banking system. And the question is, have we overshot the amount of capital that's the right risk-reward trade-off for society as a whole? Do we require JP Morgan to carry too much capital? Do we require UBS to carry too much capital? That's, I think, a legitimate question that one needs to think about now that we're post-crisis. The second issue is, what will be the return on this capital? And again, as capital markets become ever more efficient, particularly in the United States, it's ever harder for banks to make money lending to corporate America. And so the banking system, if you think about our U.S. banks, credit cards, for example, are so important because it's one of the last bastions of real economic rents available to our banks.
Just on, since we're on the banks, I think the other part of the NIM is the cost structure, right? The other part is the net interest margin. And a number of European banks are overbanked in that sense. Too many branches in too many places, and they have to take an axe to their cost structure along with what Ken talked about. And I would echo that point about capital. I think the history of every crisis is we start out at a point where the system is under-regulated, and we impose regulation after regulation, and soon before we know it, we are at a point that we perhaps have crossed the appropriate level. And it's useful to reflect on that before we get to the situation where it's obvious we have over-regulated, and then there's a push to cut back the regulation. We go back through the cycle, we then get back to a position of under-regulation. Pro-cyclical regulation goes with the territory, and I think it's problematic. I think it's better to reflect on how far we are and whether we need to roll back at this point.
Jay, one thing you had one sentence in there about the Volcker rule in your remarks, but you kind of whacked the Volcker rule a little while ago. Do you want to
Whack it again?
Yeah, or
Sure.
see if it fits Raghu's example of going too far, perhaps?
Yeah, I think it does. And again, these are just my views. I would stress. So I think I would say that I would agree that we don't want the largest financial institutions to be, seriously engaged in proprietary trading as a line of business. We do want them to be able to hedge their positions and be able to create markets. So the question is, does the Volcker rule, as it's been enacted by Congress and in a 15-page statute and promulgated in a 300-page regulation, does it do that? efficiently? And the answer really is, in my view, no, and I believe Congress should take another look at that. So let me say a little bit more about that. Its trading book risk was not well addressed by pre-crisis regulation, but since the crisis, we've done Basel 2.5, which directly addresses trading book risk. We've got Basel 3, which much higher capital for the largest institutions. We've got central clearing of swaps. We've got margins for uncleared swaps. We've done many, many things. We've got stress tests, which focus very much on the trading book. So we've done all of these things. It would be possible, I think, to accomplish what I said at the beginning, which is no proprietary trading as a line of business. But what the current law and rule do is effectively force you to look into the mind and heart of every trader on every trade to see whether the intent is proprietary trading or something else. And if that's the test you set yourself, you're going to wind up with tremendous expense and burden, and as I would say, really quite marginal benefit. So, okay, so
I think there's a perhaps an alternative perspective though on this, which is, for the life of me, I still don't understand why Goldman Sachs is a bank. I mean, I understand why they might want the government subsidies of being a bank, but for the life of me, I don't understand why the U.S. taxpayer stands behind Goldman Sachs. Who here thinks this is a great idea that they are on the hook for the trading activities of an investment bank? And by the way, if Goldman Sachs goes bankrupt, no company in America other than Goldman will miss payroll. It's a very different animal than a JP Morgan or Bank of America or Wells Fargo, which is critical to the infrastructure of our payment system and payrolls in America, and instrumental in both consumer credit and small and medium enterprise loans. And by the way, I doubt anyone in this room has a deposit account at Goldman Sachs.
You don't?
I don't. I got a prime brokerage account. Northern Trust and JP Morgan, just to give a little Bank of America. But all banks, by the way. So I think Volcker, in some sense, is a rule that is in search of a problem that can be corrected by asking, should investment banking and trading exist under a banking license or under a securities dealer license? And by the way, if a securities dealer fails, it should go bankrupt. A firm that pays its employees tens of millions of dollars in good years should go bankrupt when mismanaged and should not be at the trough of the taxpayer for a handout.
The audience is clamoring to get Jay and Raghu to take up Ken's question of whether we've gone too far on the level of capital. I don't know if you guys want to say anything about that, but I'm the messenger.
Okay. Well, look, I do think that it imposes a particular cost on credit risk taking. And I want to pick up on a comment that Governor Powell made earlier, which was that even as monetary policy is trying to take up the burdens of restoring growth, regulatory policy has been going the other way, perhaps for good reason early on in the post-crisis regulation. We needed to set regulation right. The levels of leverage at banks were extremely high. But we should not also act as if there is no cost of capital effect of demanding higher equity levels at the banks. And what tends to suffer is really the activities that the banks are really key in, the small and medium enterprises, the lending to new projects in emerging markets and so on, all of which are important in order to revive growth. So I would say that if there are activities that have suffered, that's probably where we should look. Again, we need more evidence. What is the appropriate level of capital? I don't think anybody really knows. I think we'll look at it and see in hindsight that perhaps we have been either excessive or hopefully not, that we have been too lax.
No comment. Okay. Let's go back to this question of whether or not it's run its course, and we've been low for so long that the potency is gone. What are the touchstone. So Jay, you had a bunch of charts, and at some point it gets hard because if you've got 9 measures, 2 of them are going to be ticking and 4 of them won't. And so, is there a sufficient statistic or a handful of things to where if you saw that, we would know that the reaching for yield has actually crossed a threshold where it demands action, or is it, going to be like the Supreme Court on pornography?
Yeah, no, exactly. So I think there are markets where you can see it clearly, I think relatively clearly. Like, for example, I think in the leveraged finance markets, you see it in basically non-price terms. So you see, when the buyers have the advantage, buyers of the paper have the advantage, you'll see, no covenants and very low rates, or non-price terms like lack of covenants and that sort of thing. And very attractive underwriting terms. And when the sellers have the advantage, you see it all turn around. So you can observe it quickly. When you get to the broader fixed income markets, it's much harder. This goes back to something that Raghu was touched on early in his remarks, and that is, we all think that the neutral rate of interest has fallen, and a lot of the assessments that I made about valuation assume that is right. And it's something it probably has fallen in the short term, but is that really a sustainable thing? We really don't know. So we don't know whether the neutral long-term rate is 3% as the median FOMC participant thinks, or whether it will go back up to the 4s where it was for a long time before. In terms of risk premiums for risky assets, they're time varying. They go up, they go down. They're not stable. So I think bottom line, it's very hard to say in a world of, let's say there's a world of very high PEs, but also high equity premiums. So which do you look at? The piece of it that you can identify, and again, we don't see it, is the buildup of leverage, and particularly as associated with real estate. That tells you that things are getting hot and dangerous. So I think the bottom line is it's very hard to pin it down.
The 10-year rate is something that's bothered me for some time. I mean, we have an inflation target of 2. We have a 10-year rate that's been well below 3 for years now. And it seems a little odd, to me at least, that we're so close to achieving the mandate, and you have a 10-year rate that's got, it just seems like that's got to be below where you'd expect if the economy just sat still for 5 years. Would you really think a 10-year rate of 240 is reasonable? I mean, Ken, what would you think if the Fed wasn't distorting the markets, of course, what would the 10-year rate look like?
Well, number one is it depends on what we mean by distorting. What do we mean by distorting the market, right? So there's 2 issues here. There's the large accumulated QE portfolio, and then there's the short-term interest rate policy. Those are the 2 key drivers today. And the Fed's made it clear they're going to try to raise rates off the zero boundary, which they've done, before they unwind the QE portfolio. I think that the logic being that if there was a financial crisis, cutting rates is much easier to do than increasing yet again the size of the QE portfolio. So that's the current trade-off being made. And I think I may not have made the same trade-off, but it's a completely reasonable trade-off. All right, so let's just take that as a backdrop. So if QE didn't exist, maybe we'd see the 10-year with a 3 handle, 3.0 for sake of the argument. There's a real interesting question, which is, what is the real return achievable today in our investment opportunities domestically and abroad? And in particular, a tremendous amount of value that's been created in the equity market over the course of the last decade. The Googles, the Amazons, the Snapchats, which we're talking a $25 billion valuation, these businesses did not demand very much capital to either come into existence or to grow. And the shared economy that we see in Airbnb or with Uber applies also to corporate America. For example, we'll use 100,000 cores in Google's server farm on a completely variable pricing protocol. That's hundreds of millions of dollars of hardware. If you went back a decade, it'd be several $billion worth of hardware that we use on a completely variable basis. We see this not just in financial services, but in biotechnology, drug R&D, machine learning is all done today, by and large, in cloud-like resources. So we're in a state of the world where we have tremendous global savings, but do we have enough risky projects to invest this in so as to create a meaningful return for investors?
So, I mean, just to that last question, I think we have, but we don't know how to get it there. I mean, there's plenty of projects around the world, meaningful, high-return projects. If we could control, if we could have adequate governance, if we could have adequate credibility of people doing the projects. And unfortunately, to my mind, this is part of the international discussion which has sort of faltered as countries have had their own problems and looked inwards. How do we get cross-border investment into some of these long-term infrastructure projects going in the right way? I mean, it's clear there are many countries which need infrastructure, this country included. But it's much more obvious in some parts of the world, and we need to think about how to energize that, especially in an environment of slow global demand. That discussion has gone off the table as countries have focused inward, and I think we should resume that if we can.
Be helpful. Let's turn a little to the political side of things. We haven't talked about that so much, but certainly all of you mentioned that central banks are, at the boundary of their mandate, it seems. And there has been a lot of blowback. Ken mentioned Brexit. The election here was a little bit surprising to many people. Do you think that the central banks are in serious jeopardy of losing their independence? And if they are, what can be done to kind of manage that risk? And if you want to take issue with the question of whether they should be independent, feel free. I'm kind of assuming we all think that it's a good idea to kind of get out of the way and let them try to do their job. But it seems to me you could be quite nervous that an onslaught is coming.
Well, can I take a first
Sure.
crack at that? I mean, I do think that having become the only game in town, it has two consequences. One, which Ken mentioned, which is that the other sort of arms don't sort of take up as much, and they put more pressure on you to do things. But also because you're unelected and because you're adopting instruments that are not quite in the traditional mandate, you expose yourself to the politician who resents the stage that the central banker occupies, especially because this is somebody who's unelected. And typically the kind of criticism doesn't come from the government itself. It comes from people outside the government who have a free hand in leveling criticism. And my worry is that in this environment where there's a lot of angst about the institutions of capitalism, about the global elite, so to speak, central bankers are well and truly card-carrying members of that elite. Many of them have PhDs, many of them meet in obscure places like Basel, and they concoct global plots to override national sovereignty, and therefore they're suspect. And I do fear that there will be pressures to bring more oversight precisely at a time when the traditional reason for independence, combating inflation, becomes actually more important. So I think it is a definite worry. I do hope better sense prevails, but I think central bankers have become sort of objects of attack.
Is there anything you think that they can do that they're not doing to try to manage that, or to change the dialogue, or hedge the risk?
Well, you're damned if you do and damned if you don't. Speaking as a former central banker, if you speak out a lot, you occupy territory that the politician wants to occupy. And that is a problem. If you don't speak, then you're not telling the public what you're doing and why you're doing it. And that too is a problem. So finding the appropriate sort of level at which you communicate I think it's important to communicate and to say why you're doing things, why they're important, why they're in a purely technocratic fashion as opposed to you taking political sides. But invariably, I think you do come under attack.
You want to say anything?
No, I'd say, just in fairness to the Fed, I think they did a really great job, 08, 09, 10, dealing with a crisis that was significant both domestically and globally. I applaud them for making decisions and for taking bold actions and not being caught up in analysis paralysis. They really did, I think, an incredibly good job with high stakes under pressure. I said earlier, the debate between raising rates and reducing quantitative easing, I would have started to rapidly unwind QE several years ago, even at a cost to our economy in terms of higher rates. Because the unconventional policy, I think, is what creates the greatest angst within the business community and amongst those who have assets of means. If the Fed is engaged in unconventional policy, just as negative rates in Europe caused an equity market correction or in Japan caused an equity market correction, unconventional policy creates a level of uncertainty about what is the true equilibrium. And I think fundamentally it also has taken the politicians off the hook for some of their very poor policy decisions post the financial crisis. The first country to aggressively reform its labor markets, to aggressively engage in pro-growth business policies is going to win. And right now, the central banks around the world continue to address the symptoms of sick patients. Patients need to find a cure. That cure comes from the policy side.
Yeah, I was going to ask at some point, Jeremy Stein and some co-authors had a paper, Jackson Hole, arguing that a large Fed balance sheet was good for financial stability, and that part of what they could be doing is mopping up this very sharp term premium at the shortest end of the yield curve. So, Ken, I take it you just reject that. You don't want them to have much of a footprint.
I think that's insane. Sorry, Jeremy, but I think it's insane. And I think in particular, we want to encourage our capital markets and investors to focus not on short-term investments, but on the 5 to 15-year points, which is where real capital formation takes place. When corporate America wants to build a new factory, they can't fund it with commercial paper. They fund it with 15 and 20-year debt. And so everything that we do to continue to facilitate the short-term mindset in our capital markets, the money market funds, bank deposit base, so on and so forth, discourages what we really need, which is we need people to think about making investments that have horizons of a decade or 2 decades that mirror the time horizons of the investments that we need to make new car plants, new power plants, infrastructure for oil and gas, and so on and so forth.
I would like to. Can I just say something about the prior question, which is, so I think central banking faces really extraordinarily difficult questions and having to rebuild, the respect for the institutions that was so strong only a decade or so ago. And I don't put loss of independence at quite at the very top of that list. I think there will be lots at the end when all is said and done. There will be more said than done, and I don't feel as though our independence is is likely to be lost in a meaningful sense. So. So you mentioned Jeremy's paper. There are two things. One is the idea that the public wants lots and lots of safe assets and is willing to bid up those short-term treasuries to an extraordinary degree, and that if the public doesn't, if the Fed doesn't provide those safe assets, then the private sector will manufacture them, and then they'll turn out to be not money at the critical point, and you'll have runs. So that was the insight there. Really interesting idea. I don't really. It doesn't have broad support, but as usual, it's a terrifically interesting idea worth thinking about. In terms of the size of the balance sheet as a whole, the question that really boils down to if you, first of all, I think it should be no bigger than it has to be to administer monetary policy. The question is, you're going to be doing that around a framework where you're managing a rate that is an interbank unsecured rate, the federal funds rate, which is sort of a shrinking market, and that as Ken pointed out earlier, 80% or more of our intermediation happens in the capital markets, not in the banking system. So the alternative is to have a sort of a floor system where you're facing off against a broader set of counterparties. You probably have a larger balance sheet, but not a huge balance sheet. And you probably also skew it to a much shorter duration. You don't need to have, effectively what creates a lot of the fiscal risk is the duration in the portfolio. You could have a big portfolio with a short duration, bigger, no larger than it needs to be. So my guess is at the end of the day, and I think there's a lot of appeal to that over the longer term, because that is where the money markets are going and is to a broader set of counterparties. So I think you'll wind up with a balance sheet that's much smaller than the one we have now, that's bigger than it was before the portfolio.
You want to say anything about this decision to do the rates before the end of the QE? It's interesting because the Fed changed its mind on that. At one point, there was going to be downsizing. That doesn't receive so much attention, at least maybe I missed it, but it seems like in the minutes there hasn't been a reconsideration of that in a while. Do you think that that's going to be something that gets more discussion once you're further away from zero? That this question of whether or not we should maybe slow down on the hikes but start shrinking the balance sheet comes back as a question, or do you think that that's kind of, settled?
Well, so I think Ken stated the rationale exactly right. It's the idea is, and this is my own view, that you want to, you're removing accommodation either by shrinking the balance sheet or by raising rates, and it's kind of one or the other. And what you really want is you want to get as far away from zero as you can. I would like to before it's necessary to start cutting rates. So, because exactly as Ken said, cranking up more QE is going to be much more challenging than just cutting traditional rates. Plus, we just know so much more about rates than we do asset purchases. We have really very rudimentary knowledge of the way asset purchases affect financial markets, let alone how they affect the real economy. So that's the rationale. So, but yes, at a certain point, and we're not at that point now, you will be at the point at which you can stop reinvesting. And so it's not something I think for precisely the current moment, but over time, the balance sheet is certainly, I would expect it to shrink to a much smaller size.
One of the things Ken pointed out that we haven't touched on was this intergenerational aspect of the way that QE and low rates have played out. It hasn't been a big part of the discussion here, but it's a rampaging discussion in Japan as to one of the issues there. Do you think that is something that, in retrospect, will be part of the narrative? So in 5 years, when we look back, will people be making that point in a way that is emphasized a lot more than it's been so far? Or do you think that it's largely going to go undetected? Certainly not a fact that when people stand up and talk about the experience of the last 3 or 4 years, you say, wow, the young really got the shaft and the elderly were the big winners here.
I think this goes to the point that Governor Powell just made, that more broadly, there is public acceptance of the interest rate instrument. There's also better knowledge we have about it. And to that extent, even though that does create winners and losers, that's part and parcel of the accepted role of monetary policy. I think once you depart from that and go into more exotic instruments which haven't been part of the tool set, so to speak, there's more of a potential allegation that you're choosing sides between borrowers and lenders, between the old and the young, and so on. And I think that we don't fully understand. So, for example, take a very low interest rate, negative interest rates. You might think that would have an effect on the capital value of assets. Again, the question is how long. But that also has an effect on the flows. So depending on whether you are somebody who's invested in flows more, bank deposits, or whether you're invested in bonds, it does affect which side you would be on that play. So my sense is it's just part of this larger exposure to political criticism because you're making what are effectively fiscal decisions rather than what are usually thought of as purely monetary decisions. And that's, I think an area which central banks would be wise to get out of as soon as we can.
You want to add anything? No? One of the points Raghu made was this point about liquidity and leverage and how these things can be kind of deceiving, that everything looks good for a while and then suddenly you have the Wile E. Coyote moment, you out over the cliff. How do we guard against that? And what can be done? Is some sand in the wheels something you favor? I don't know, Raghu, if you want to elaborate a little bit more about what you and Doug think at this point is the right way to manage this, because some of it is a program feature. It's not a bug. So how do you feel like you can control it?
No, look, I think there aren't any easy solutions. The point, however, is that the answer to every leverage bust is let's slow down the deleveraging, which means let's infuse more liquidity, which risks precipitating once again that liquidity leverage race, as liquidity suppose more leverage then requires liquidity. And the question is, at what point are you unable to do this anymore? And the worry, I guess, that we express is more that the institutions that support the other side tend to erode if the boom is long and persistent. I mean, as a very trite example, in boom times, there's very little need for forensic accountants. And that profession sort of, doesn't attract very many people. Then there's a bust. And that's when you want people to figure out what's going on, and nobody's trained in that area for quite some time. Any sort of long policy in any particular direction tends to have that feature. And the key difference here is that you've got the leverage built up over this period.
I mean, a corollary to that is we're 8 years into a recovery in the United States. Now, I think it's statistical fact that recoveries don't die of old age. There's not much, if you look at the kind of hazard rate, there's no cliff or something that you find actually in the data. But it is, I think, surprising to most people that we've been able to go this long, and especially since the economy now looks maybe better than it has in a long time. So you might think that we're in a strong position now than we've been at the start of any year for the last 3 or 4. So does that speak then to the pace of the normalization that we want to achieve? If you want to take out a little insurance, is now a good time? It seems like the Fed has resisted that a little bit. There's a nice chart that I saw the other day that counts the number of times that Chairman Yellen says gradual in the press conference. Gradual is gone. It's down to 2 at the last press conference. But how do you balance all of this? That we're in this strong position. We've been growing for some time now, yet we're still kind of with very low rates in real terms, surprisingly low, I would say. Does at some point we get back to normal where we start kind of, go back to a positive real interest rate in relative short order? You have a view on that?
You're going to make me fall back on the talking points here.
No. Well, I haven't heard them in a while, so.
No. So I think if you take a step back, we've been seeing these sharp declines in unemployment, which has slowed down a little bit as the labor force participation rate has flattened out and increased a little bit. So, but you're now at or below full employment, and yet policy is very accommodative still, and growth is definitely strengthened in the second half of the year. So you had 3 dissents at our September meeting and 2 at the October meeting. And the discussion in the minutes, of course, was around, the way to preserve, to lengthen this recovery is to get moving now on. And so that's the debate. And I think it's the right debate to have. Subsequent to those meetings, you then have asset prices going up, measures of confidence going up, and sort of a very positive feeling about the economy. Rates going up, the price of oil going up, inflation expectations going up. So you have a situation where you've got decent momentum and I'd say more upside risk than we've seen before. And yes, all of that has to go into the cake. The other thing to remember, though, is that little third dot, which could be accomplished, if you remember the day of the announcement after the December meeting, that third dot, which is a pretty small thing when you think about it, it's just the median, so the movement of a couple of people could have accomplished going from 2 to 3 increases on a highly conditional basis in 2017. That moved the dollar close to 2%. So the dollar has been very sensitive to news about the forward path of interest rates. So that in a way may be a speed limit. But you put all of that into the hopper and think about it, and that's what I'll be thinking about.
One of the things that I guess was mentioned by Raghu was these questions of whether or not some of these countries are actually going to be asleep at the wheel and be underprepared. A couple people asked, would you want to indicate who you think it is? Name and shame.
I'll still wear my central banker hat and say, look, I think countries don't deliberately sort of get into these situations. Almost always, it has to do with political uncertainty that increases in those countries. That given a certain macro situation, worsens the macro situation a little bit, but really makes it untenable because the political uncertainty coupled with the more fragile macro situation makes it ripe for problems. I think if you look around the world, ask yourself the question, who has had significantly increased levels of political uncertainty, who's running a large current account deficit, whose currency has been depreciating significantly, and you will come up with all the answers that I would have in my head.
Ken, you called out Brexit as a big event. You have any advice for what the Brits should be doing? Now that they voted to leave, how would you manage it?
So there's two dimensions to this. Number one is, to the extent that the European Union thinks you're going to play hardball and win, we're all going to lose. We're all going to lose. Because Europe doesn't have enough growth to fritter it away in a set of protectionist policies vis-a-vis the UK. So I really hope that both parties realize they've got too much to lose to turn this into a drag-out, knockdown fight. I think timing-wise, the choice of exiting now, right in front of the French and German elections, is an interesting decision. That's going to create, I think, some really, we're going to have 6 lost months here. And with a 2-year window to get to a finish line, I think those 6 lost months is a real loss. In my wildest dream, Trump cuts a trade deal with England right here, right now. And that would be incredibly powerful for the world, because it would show, number one, the U.S. is not going to retreat into a protectionist position, and number two is it puts pressure on Europe for a better deal with the United Kingdom. So that would be if I could have a dream on the UK right here, right now, it's that one of the first moves we make is actually to cut a trade deal with what has been unquestionably America's closest ally for 2 centuries.
All right, we made it 90 minutes with no Trump, but you just opened the floodgates. So, I mean, people want to, there have been some questions here about, what do we think the Trump administration is going to mean for the Fed and for the economy? And if you want to just give a wish list of what you hope they might do, that'd be interesting. But I'd also be curious about just prediction of where you think these many promises that seem to be conflicting with each other are going to lead us. I mean, is there anything we can gather from what we know at this point to make any informed guesses about where we're headed or where we should be headed? I don't know. Surely have a view.
So I've had a chance to speak to some of the people that are working on the transition team issues and on policy going forward. And let me be clear, they understand the only possible long-run American success story is predicated on growth. There is no other way out of the current predicament of very substantial structural entitlement programs and a workforce that has faced wage stagnation now for decades. So there's no doubt that the number one priority of the administration is going to be how do we encourage growth in America? Less regulation, hands down, a real lever they're going to pull on. Number two is they're going to pull on how to improve new business formation, which is at an all-time low. You know, it's sort of funny. We idolize as a country this idea of the Facebooks and the Googles and the Amazons, but new business formation is at an almost all-time low in the last 20 years. We're not seeing entrepreneurship in America, which is so important to creating value for consumers and creating high-paid jobs. So growth is number one. We will see some infrastructure spend, no doubt about it. We'll probably not see a meaningful tax cut when all's said and done for private citizens. I think the hard reality of just how significant our budget deficit is and our accumulated deficit is will weigh heavily on a Republican Congress in terms of the contours of a tax plan. So unfortunately, we're going to have to get to growth by deregulation, by encouraging incentives for capital formation. We're not going to get there through $1 trillion infrastructure spend and through a massive tax cut. The numbers just don't work. And I think that's the reality that we're going to grapple with over the course of the next 12 months. The other big issue is going to, of course, be healthcare. Healthcare is on a trend again to get 20% of GDP in the next couple of years, which is a terrifying number. I used to always think this was a good thing. This means that we have so much money we can spend more than ever on healthcare. But since we haven't seen real wages grow for the median family in America, what we're really seeing is healthcare costs crowding out spending on clothing, spending on going out, spending on entertainment. It's part of what creates this dissatisfaction in America, is with median incomes not going up and healthcare costs accelerating, we're now starting to see a real crowding out of the other spending that we enjoy in America. So healthcare reform is actually going to be, I think, one of the biggest wild cards of this administration. We just can't repeal Obamacare unless we have an alternative that is going to change the trend cost rate in healthcare.
Do you have a view on whether this deregulation agenda is plausibly going to deliver the kind of growth numbers they're talking about? I mean, the document that I've seen says 3.5%, which seems like, you know, I want to play in the NBA, but that ain't going to happen either. You know.
You know, what's amazing is how many. It must now literally be millions of Americans are embedded in the cost of compliance on the back of the last 8 years. I mean, if I talk to my friends at the large banks, you will have compliance functions of 30,000 people. And let's be clear, we all sort of make fun of the compliance department, just sort of inherent in our country. Oh yeah, it's compliance. 30,000, these are well-educated people. These are people whose talents are not being put to creating goods and services that we enjoy day out and day in our lives. They're in compliance functions. They're literally creating paper to be sent, sorry Jay, to the Fed, to end up in filing cabinets, which will never be accessed or used. There's no value creation proposition. That's in financial services. We see the same thing across the entire economy. This just dramatic increase in reporting obligations to the government, paper pushing for the government. There's no good or service that you and I consume on the back of that. So if we want to compete with the rest of the world, we're going to have to think about how to bring that load down. And here's the other issue. I mean, I was on the board of a bank. All you talk about in a board meeting is compliance. Yeah. There's growth strategies like topic number 8. topic number one at this particular bank, this has been a long time, was, at one point in time was we didn't have the appropriate mortgage underwriting standards with respect to floods, except we didn't underwrite mortgages anymore. But this was a hot button with our bank regulator. Like, are you kidding me? Like, we're not even in the business of underwriting mortgages and you're worried about our flood policies and procedures? But that's consuming the board time across more and more of corporate America, not growth, not risk-taking, but risk mitigation.
Yeah, it's not good. You want to, yeah?
No, I think that one of the things you hear from business is really how the regulatory ante had been upped. It's not so much new regulation, but enforcements of regulations that were on the books over the last administration. You had people in charge of regulatory agencies who were very intent on doing that. And now we have the opposite. We have people who were, on the outside railing at the regulatory agencies now being put in charge of the regulatory agencies. So I do think even without any bonfire of regulations, as they say, in a legislative way, you may have a change in the enforcement, which may have a substantial effect in going the way that Ken is talking about. I think obviously there's a risk of going too far the other way also, of taking out regulations which are really important. Certainly on the international side, as we talk about climate change, that's something to worry about. But certainly the pendulum is swinging the other way.
So obviously, since we're talking about the financial system, I mean, one big question is Dodd-Frank and whether there's any part of it that's really going to get reconsidered and amended. I don't know that the Fed has ever pointed out to any parts that you would like to have seen fixed up, or where you see that there could be something productive done. But do any of you see a role for amending Dodd-Frank? Let's get rid of the Volcker Rule part, take that out. But are there other parts of that where a fresh look could be productive?
We don't have 2 hours. We don't have 2 hours. I mean, some that just jump out, that scream out for attention, are the orderly liquidation authority in Dodd-Frank, which is disorderly to say the least. Where the government, I mean, one of the issues in capital formation is when the government picks winners and losers, no one plays. And so under OLA, the government picks what creditors get paid and which ones don't. And that will affect our banking system in a pretty profound way in the next crisis. It's a real problem. The Consumer Protection Board, the Consumer Finance Protection Board, when you take away consumers' ability to access credit, Visa cards were an enormous driver of new business formation. I mean, let's be clear. It's not your local bank that backs your idea that you're going to start in your garage. It's your Visa card. And when you take your Visa card off the table as a source of credit for the entrepreneur who's got the crazy idea in a weekend that turns into Apple Computer, it's not the story of Apple for what it's worth, but you take away a really important source of new business formation. And so everything that we do to quote, protect consumers actually disempowers consumers. It's really important that our financial regulation revolve around transparency to the consumer. Simple statements of the interest and penalties that you'll pay on a mortgage or on a credit card. Like, I've always thought that in the mortgage response, it should be that when you get a mortgage and it's adjustable rate, you're on video. And if interest rates are 5%, you'd state what your monthly payment's going to be. So you indicate that you understand it. But today, you're supposed to note that you understand your mortgage because it's 200 pages long. And find somebody who's actually read their mortgage documents on a closing. Like, that person doesn't exist. All right, so we've gone from transparency as the key, which in my opinion, the key driver of consumer protection, to either a tangled mess of paperwork that no one understands, or simply denying people options. And I really don't want a bureaucrat in Washington to tell me that I can't risk personal bankruptcy in pursuing my dream. I mean, this is America. A lot of the entrepreneurs in the West Coast, They've had multiple bankruptcies. Try again. And you know what? It's okay in America. It's not okay in France. That's why there is no Google in France. There's no Amazon in France. There's no Facebook in France, because in France, it's not okay to fail. But in the United States, we kind of love the comeback story. It's part of what makes America America. And unfortunately, Dodd-Frank just puts a stake in the heart of that culture.
Okay, so it's been 20 minutes since anybody submitted a question, so I'm going to call to close in a minute the session, but I'm going to give you each a minute or two to just add anything else you want to share. Last thoughts. You can tell us when you're going to raise rates or something like that. Which variable you're looking at. Is there any closing thoughts? I mean, anybody want to stake a prediction for 2017 about global monetary policy?
Sure.
Yeah. No? Okay, well, thank you very much.